Okay, so here we are in exercise 18-5B. This is a sale with a right of return. So we've got a company here who's sold a product to its 5 largest customers, and the customers have the unconditional right to return these products if not fully satisfied. The return period extends for 4 months. The sale takes place on January 2nd, 2014, and the amount of the sale is $2 million. So again, a sale with right of return. Let's briefly review what we talked about in class in terms of the circumstances in which it's appropriate to recognize sales at the time of sale, when that sale carries with it a right of return. So we mentioned in class there are 6 criteria here that have to be met. The biggest issue is this last one, whether or not the seller can reasonably estimate the amount of future returns, if usually these other conditions will be met. So in this particular instance, let's assume that conditions 1 through 5 are met, and the question is whether condition 6 has been met. If condition 6 has been met, then we go ahead and recognize revenue at the time of the sale. If condition 6 is not met, then we delay recognizing the revenue until the right of return expires or condition 6 is met, whichever occurs first. So if we go back and look at the facts of the problem, we'll see that we're told specifically here that the selling company, Gyro, is able to estimate the likelihood of return on these sales and estimates that likelihood at 60%. So that 6th condition has been met. Again, by assumption, we're assuming that conditions 1 through 5 have been met. So it's appropriate for us to go ahead and recognize the sales revenue at the time of the sale. So we're going to debit accounts receivable for the amount of the sale, and credit, of course, sales revenue for the amount of the sale. Next, however, we have to estimate the amount of sales that we think will be returned. And what we're told here is the estimated amount of the sales return is 20%. So our best guess is that 20% of $2 million or $400,000 will be the amount of sales returns. So consistent with what we said in class, we're going to make a journal entry debiting a contra sales account called sales return and allowances, and we're going to credit a contra asset account called allowance for sales returns and allowances for the estimated amount of sales returns, which we said was $400,000. This contra sales account, sales return and allowances, is offset. It's got a debit balance. It's offset against sales revenue on the income statement, so it serves to reduce the amount of sales revenue reported on the income statement. This contra asset account, allowance for sales returns and allowances, is an offset against accounts receivable, so it serves to reduce the balance of accounts receivable on the balance sheet. So the amount of sales returns, again, that we estimated is $400,000. So we're going to prepare that journal entry. Debit sales return and allowances, that contra sales account, for $400,000, our estimated amount of returns, and credit the allowance for sales returns, which is our account receivable contra asset account, for the same amount. Now, on part B of the problem, we're asked to assume that one of the customers returns the product on during the return period. In this case, the return takes place on March 1st, 2014, and we're asked to book the return of that. So the guy returned the product in full. He no longer owes us the $200,000. That was the amount of the purchase price. It's what the guy paid to buy the product from us. So we're clearly going to remove from accounts receivable what he owes us, the $200,000. And then the offset to that entry is going to go against that account receivable contra asset account called allowance for sales returns. That's the same account as the account here. So the accounting for this is has a lot of similarities to what we do in accounting for bad debt expense. In the case of bad debt expense, if you'll think back to intermediate 1, you estimate the amount of products that you've manufactured that eventually are going to prove to be defective, and debit bad debt expense, credit allowance for doubtful accounts. Well, here we're doing the same thing, except what we're estimating is the dollar amount of sales that are going to be returned. And instead of debiting bad debt an income statement account called bad debt expense, we debit a contra sales account called sales return and allowances, and credit the contra asset account that is the analog of the allowance for doubtful accounts account. So Part C asks us to describe what we're going to do if we're unable to reliably estimate these returns. In other words, what do we do if condition 6 here is not met? And what we do if condition 6 is not met is defer recognition of the sales revenue until the right of return expires or condition 6 is met. So in our case here, we would defer recognition of sales revenue if we're unable to reliably estimate these returns.